92 searchers, 35 deals, 13 exits, and somewhere in those numbers, a lot of things that went wrong. Today's guest has been investing in private equity succession situations in German-speaking Europe since 1989. He co-founded Affinum and later Rigeto, two of the most respected mid-market firms in the DACH region. About 10 years ago, he added search funds to that work. And since then, he has backed over 90 searchers, seen over 30 deals closed, and watched 30 of them exit. That means he has also watched deals fall apart, transitions go wrong, and new CEOs make mistakes that nobody warned him about. And today, he's willing to talk about what can go wrong and what ETA entrepreneurs need to be aware of. Most recently, Thomas co-founded Valmaris, a private investment holding that brings together experienced search fund investors to support European searchers. And he is a supporter of Lineage, as well as of this podcast, for which I'm genuinely grateful. Thomas Bühler, welcome to Lineage. Let's start where most people don't. Not with the deals that closed, but with the searchers that never got there. You've backed over 92 searchers to date, and a lot of them didn't find a deal, or they took far longer than they should have. When you look at across those cases, what went wrong?
Well, that's a difficult question because many chances to fail when you search a company. Yeah? Let's say one potential situation is that searchers fall in love with a deal, a potential deal, negotiates a deal, makes a due diligence for 9 months, even for 12 months, and they run out of time and out of money. It's just one point that can happen. Another potential situation where you fail is when you just have bad luck. Yeah, you negotiate, you make everything right, but the seller pulls the deal, worst case, at the notary, because he decides not to sell at all. And that's the worst what can happen, because then you did nothing wrong, but it was a seller's decision, his emotion, whatever, not to sell. Yeah?
If I can double tap on the falling in love part, because that's something we also recurrently see. Searchers face the problem that at some point in the due diligence, they really need to commit because the costs stack up. What would you advise a searcher in such a scenario?
I would always advise not to come to this point, but to think about a potential problem earlier. I think you can avoid such a situation when you regularly communicate with your board or your investors that are involved and the investors that have some know-how how to make an acquisition, people that are experienced in private equity, for example. So because when you spend too much time, energy, emotion, and money on one deal, you are not open for other deals anymore. So we always recommend searchers to have sufficient deal flow parallel to negotiating in one deal. This is more easy when it's a team of two searchers, because when it's two, one can be in love with the deal and the other one can step back a little bit and keep the deal flow machine running. But we think that's very important. When you are a single searcher, a solo searcher, you should more communicate with your investors and your board, because you need somebody who can be a sounding board for your problems, for your emotions, for your love with a deal. And when you fall too much in love with a deal, you're not open for the problems anymore. Every deal, every company, every industry has potential problems. So you have to try to be quite neutral, but also have sufficient emotion and sufficient drive to make the deal. It's a very difficult situation you can manage when you have somebody you talk to regularly.
You have maybe a concrete example of, where you advise the searcher to go ahead with a deal, knowing that the budget would be cut short?
Yeah, I would even say if you are a searcher who is in close to communication with his investors, where investors know how the searcher is working, and you just have, for example, bad luck, the seller pulls the deal, and go to your investors early enough and ask for prolongation. And I've seen several cases where prolongation was not a problem. For another 6 months, another 12 months with sufficient money for a new due diligence.
How would that be structured? Because I think not a lot of searchers know that this is actually an option when they are in such a situation.
Let's say the easiest way is when every investor participates, and then you make a pro rata capital increase of the search capital. So I would always recommend to think about the cap table early enough to have people on board that would be willing to give you another 20-25% of what they initially invested for the next step. Other investors in the market that never support such a prolongation, you should be careful with. Because when you have a group of investors or some individual investors not participating, it becomes complex, because then you have to make a calculation how to increase the money without them. And that changes a pro rata later on. Yeah?
A lot of searchers in today's market are also asking themselves, what is the right number of investors?
Well, what's the ideal number? First, search fund is a searcher's game. So the searcher is in command. The searcher should have, or the searchers, when it's a team, should be the biggest shareholders. Yeah, they have, when they're successful, 25 or 30%. So not a single investor or a group of investors should come close to this. I would always recommend searchers to provide a maximum of 10, 12, maybe 15% to an investor or a group of investors. Sometimes there are more vehicles managed by, let's say, somebody who's in the background of this. Try to be the strongest investor. Try not to have too many investors. And on the other hand, you need some smaller investors, especially searchers or operators. That's very helpful to have them on board. So this increases the number. When you have 5-6 active searchers, 5-6 active operators or whatever on your cap table. But it's small amounts of money. So it's not just a pure number of investors that's important. You should have a handful of investors that have sufficient money, that are prepared to take 10, 12, 15% of your deal, but you should also have a number of people that can support you with a know-how that's very close to yours. People that did a search, that maybe even did an exit, they can support you strongly.
After you have selected the right group with all the competencies that you mentioned, everybody knows the typical criteria, what the perfect search fund deal looks like. A lot of the searchers out there have never bought a company. How would you approach it or advise a new first-time searcher in that regard?
Let's say, first of all, you mentioned it, I was involved in maybe 300 deals already. Every single deal we ever made, I could give you at least 3 reasons why we should never have met this deal. In theory, it's really, really difficult. Yeah? And when you stick to all the criteria, you will never make a deal. Let's be honest. Yeah. Every company has a problem. And when it has no problem, then you can't afford it. So you always have to be flexible to, let's say, meet as many criteria points as possible, as highly as possible, but you have to be flexible. That's really important. And as you said, most of the searchers never made a deal before. So communicate with your investors. One of the points we always recommend is have on your cap table people with transaction experience, and especially local transaction experience. When you invest in Germany, you need German experts. When you invest in Italy, you need Italian experts. So that helps you a lot.
Can you maybe give an example of one of the 300 deals you made where, did the conscious decision investing against the risk that you identified, but which turned out to be something you managed?
That's a difficult question. Yeah? Let's say what we learned is maybe it's an ideal industry. Maybe it looks like an ideal company, but a lot and much more than the company or the industry depends on the CEO. You need a strong CEO to be successful. Even in a high growth, high margin industry, when the CEO is not the right person, it doesn't work. And having a company in a difficult market, maybe not so profitable, but for a reasonable price acquired, a good CEO can create an attractive margin for the investors. So the biggest mistakes we made was bet on the wrong people and not changing bad people early enough.
What does a good working relationship between a searcher and the investor actually look like? Like in practice, when you evaluate a deal, when a searcher comes across deals, what would you expect of them in order to give both parties the best possible outcome?
I think it's very important to be efficient in deal making, and for the searcher to learn early enough how to make a deal, how to go in depth with a negotiation, with a due diligence, and so on. So what we recommend is every searcher to identify a handful of investors that are more involved in the deal making than others, because you cannot regularly communicate with 20 investors. Try to identify a group of investors that can really support you. Talk to them early enough when you have a deal. We, for example, we love to see 2, 3, 4 pages, not more, in a very early stage. Then give us a chance to think about the industry, the company, the situation, and so on. And then let's have a video conference of half an hour, and we give our comment on the situation. I think this is very important for searchers, especially when they have never been in M&A or private equity, to avoid spending time and money on situations you can obviously not make a deal out of. So that's the first step. Just try to get an idea how investors see the deal in general. You should talk to your investors early enough, not sending them 100 slides every week. Nobody is interested to read 100 slides every week because most of us are invested in more than one company. So try to keep the information limited, try to communicate the relevant information, but do it early enough and not after 6 months or whatever. When you have spent all your time and money on a deal where all investors tell you that's not a deal for us. The searcher to have a group of investors, he can just send an email, just call and get some reply early enough. What we as investors don't like is that there are many investors around that never support searchers. They're just on the cap table. So I would always recommend searchers to go for investors that are prepared to support, that are willing to invest later on. The quota, how many deals an investor declines, is very interesting. You don't want to have an investor on your cap table that declines every second deal he gets proposed, because then you have an equity gap you can manage, and equity gaps can be managed.
How do you find that out as a searcher in fundraising, speaking to dozens of investors?
Talk to searchers, talk to operators, talk to former searchers. You need investors that are willing to invest in your deal, to support you first, to invest in your deal, to support you when you run the company, but also when you go for an exit. And investors can be very helpful or can be really difficult in an exit situation. So talk to all kind of searchers in all kind of stages, who is supportive and who is not.
Search is part 1 out of 5 or actually 10 steps. And now we are in a position that we managed to successfully take on step 1. You move from being a private equity associate into the world of being a CEO. What do you see has done the most damage in a search fund acquired deal in year 1?
I think the most important thing is people. You have to convince people in the company to follow you. Imagine there are people maybe 40, 50 years old, and a 30-year-old searcher becomes the CEO. The owner did run the company for 30 years. And now there's somebody who's obviously younger, who has not much experience in running a company, and this makes people nervous. People don't like changes. So I would recommend talk to as many people as possible in a very early stage. Make them feel comfortable. Same with your suppliers, your customers, everything. But it's the people in the company that have to be convinced to follow you instead of the old owner in future.
On the people side, one thing one of our search teams, after they successfully acquired, mentioned is that when they looked at the deal and they saw like a well-prepared org chart with nice fancy titles, the idea the searcher have of this specific title and the reality of it looks very different. based on your experience, before you actually start managing the people, what can you do during also the acquisition process in order to get comfort around it?
Ideal situation would be if you had a chance to talk to the most important people prior to acquisition, interview them, have work with them, have a workshop with them. Very often, a transaction is in a competitive situation and you have no chance to talk to second level or third level. That's a problem. If you have a chance, for example, to have a workshop, a one-day workshop with the seller, his most important people, and the new CEO searchers prior to an acquisition, can give you a lot of insights how the people really fill their boxes or not. But that's difficult. And we see a lot of situations where you have no chance to talk to the people prior to that. And maybe an option to learn about the people without talking to them, obviously, is go on a trade fair. Try to meet them on a trade fair. Yeah, try to get a chance to indirectly see them, talk to them, learn about them. That makes you gives you a better picture of what kind of people you acquire. But end of the day, it will take you some time to really understand the people, to learn what strengths and weaknesses they have. One thing we learned, small company with a very strong owner, you often have people that had no chance to really grow, because there was an obvious boss over them. When you come in as new bosses, you are younger, you are more open-minded. People might grow with you and with the company, might see an opportunity for themselves. With a new, younger owner, shareholder, manager, whatever, they see a chance. Maybe they wanted to change things for 10 years now and never got the opportunity. And now it's you. You can give them the opportunity to change something. That also happens, and that's the ideal situation where you can use all the strengths, the hidden strengths of the people. And you can reward them, once with respect, second, salary and bonus, and third is an ESOP. A lot of search funds have an ESOP where they can provide shares, virtual shares to the teams.
In terms of taking over the business now, you mentioned the people aspect. Changing too much too early is a common mistake, but you as a new CEO, you have energy, you have conviction. How do you balance it?
Let's say in the first 90 days, 100 days, 3 months, 6 months, whatever, try to allocate your energy towards learning about the people, learning about the industry, and so on. Go for the low-hanging fruits, yes, but take some months to learn. And then when you have identified what you want to change, talk to your investors, talk to your board. In this case, it's more the boards and the investors when you have made an acquisition. Try to reflect your thoughts with the people in the board that are more experienced than you. Try to hear what they would recommend you. And then quite quickly switch from learning mode to changing mode. Don't wait 2 or 3 years. Do it after 6 to 9 months, maybe. Yeah, really depends on the company. But as soon as you have sufficient know-how about the company and the industry, people accept you as a new leader. Start changing. Start modernizing, growing, whatever with the company.
Do you have an example where a searcher, concrete example of a mistake a searcher led where the company then, was severely impacted after or had needed time to recover?
Difficult to go into details because you don't want to blame people on this. But let's say I can give you an example. What is really a problem very often is when the seller is too much involved still. That's an obvious mistake. We say you need a clear cut. A big mistake would be to step in the company, get an office next to the seller, and the seller stays in his old office. That's a symbol. He is still the boss. So day one, the seller has to leave his office. Day one, you have to be legally the CEO, not him anymore. Don't take a period of time where he is still in his office, where he is still the official legal CEO of the company. Doesn't work. You have to make a clear cut very early. You can and should try to learn from the seller what is important in the industry and the company and so on, but from an informal position. We also see problems when sellers are in boards. Last year, we had a situation where there was, let's say, a rep and warranty issue after the takeover of the company, and they wanted to discuss it in the board, but the seller, who is the other party in such a problem, was member of the board. So it was extremely difficult to discuss potential claims against the seller when he was in the room. There are sellers that are extremely supportive, where you never have a rep and warranty problem and so on. But it's the vast minority. There's a very good paper from Jan Simon from IESE some weeks ago, where he elaborates on the role of sellers in management, in board, in shareholding and so on. It's really worth to read this paper from Jan.
We work with equity reinvestments, maybe seller a note. How and when have you seen kind of the best CEOs have that conversation?
You cannot avoid to talk about this quite early. So I think there's no need to go in detail in a very early phase, but you don't want to have a situation that you negotiated about everything. And then after some months, you tell the seller, but we need a seller loan from you. And he said, no. So mention these points early enough, and always be aware that in most situations, when you leverage a company, the banks will never allow you to pay back the seller note earlier than the bank debt is fully repaid. I think this is a point a lot of people with no experience in this make a mistake. They promise the seller to pay back his seller loan, for example, in year 2 or 3. And in most situations, this is difficult with the bank. You have to negotiate with the bank in advance about this. Otherwise, they will never allow you to give any cash to the seller or to the shareholders.
Is there something searchers are doing wrong or should do in order to prevent a deal going rogue or going bad?
Let's say what we see is very often is some sellers don't realize that they have to pay tax on the share price. Yeah. So always try to involve sellers' tax advisor or seller's lawyer, to have somebody who's a professional who can bring a seller closer to reality. That's especially with the so-called proprietary deals. When a deal is brokered, then you often have a professional advice on seller's side. But we have seen situations where you negotiate for a month, and 2-3 weeks prior to notary, the seller realizes he has to pay tax on. Sounds stupid, but it's reality.
Wanted to touch base again on the people part in the company after you taking it over, right? You have a lot of new stakeholders you need to manage and to advise, especially for employees. What have you seen great searcher CEOs do?
Let's say in the very beginning, it's a structural issue. When you are a solo searcher, it's you against everybody. When you are 2 searchers, it's at least 2 against everybody. So when you are a solo searcher in a very early stage, you need support, more likely from outside. Maybe out of the company, you promote somebody to CFO, to COO, whatever. But you need a kind of a fan club in the company, that's following you, coming from outside, coming from inside. But it's a small group of managers. You need to have somebody you can talk to. And this is not only the board. Yeah, the board can take this role, but also you need somebody in day-to-day business who is on your side.
How do you find those people? Or how would you build such a relationship, in your opinion?
Yeah, when it's from inside the company, it's somebody who was a number 2 or number 3 or whatever in the company for some time, but is explicitly younger than the seller and is his chance to grow with you. So that can be the right person, or you recruit the person from outside. Use the network of your investors. A lot of investors have a network in this field of CFOs, yours, and so where they can support you.
Is that something you see across many deals, that, hiring outside expertise early on is common? And if so, what role would that typically be?
It's person or the position where it's done most frequently is the CFO. Yeah, it's a CFO. Because a lot of companies, privately owned companies, don't have such a controlling or accounting that really understands the figures. So yeah, when you're a solo searcher, you need a strong CFO. That's a recommendation. Yeah.
Where have you seen searchers spend actually the most time on in the, let's say, first 6 months, which is not really talked about or not many people are aware of it?
Again, it's very different depending on the company. When you're, for example, in B2B business, you should see customers. Yeah, you should talk to customers a lot. So it's more difficult in B2C. But try to understand the company's business. Try to understand your customers, the market, and then the next step, go into operations. You're selling software. Yeah, first of all, you have to understand the needs of your B2B customers, and then you look what is our product, to how we are developing it. Yeah. For example, when you're in a manufacturing company, yeah, first of all, you see what kind of product does the market need, and then how can I improve production, assembly lines, whatever. Every company is different.
Last point on that part is, we're not looking for an employee. We're looking for somebody who takes ownership, drives a company forward, and at the same time is lacking the experience. In terms of working on the board, would you say are best practices?
Let's say normally you have 4, 5, 6 board meetings a year, but that's more the formal situation. I would always recommend to talk to the board members more frequently in the beginning. Just communicate your potential problems, communicate what happens in the company, make a bi-weekly phone call with every board member, for example, in the beginning. Yeah, just on one hand to reflect, yeah, to have a sounding board on what you think might be a problem or might be not a problem. And on the other hand, you also give the board a chance to learn about the company. Because when they are involved in the details, when they're involved in the potential problems, they can better advise you compared to having a meeting every 3 months.
Can you think of an example where, there was disagreement between what the searcher wanted and where the board advised it? What are the topics, and maybe what are also the outcomes of such a discussion in more detail?
Let's say when you have a disagreement between the board and the searcher or the CEO, how to run the company, that's difficult, yeah. But it's never black and white. When you agree on 80% and disagree on 20%, both sides have to be prepared to fill this gap and to be somehow flexible. And normally that works. When you have a disagreement in principle, it's more complex. Then maybe it's important to look at the figures, yeah. When everything is great, when the performance is great, it's difficult for the board to say, yeah, what you do is wrong. When the figures go south, then it's difficult for the CEO to say, I'm right. So again, it's communication and understanding each other. And let's say that's for the normal course of business. When you, for example, want to change the business from a normal business to a SaaS business, yeah, and board wants to change, searcher doesn't want to change, or the other way around, then it's really difficult.
Do you have like a concrete example where that happened?
I've seen 3, 4 situations where the performance of, let's say, at least one of the 2 CEOs was not as expected. And then you have to go in communication and talk to the people and find a solution. And the solution can be, let's say, giving him different jobs in the company, yeah, something he might be better on, or in worst case, to replace the CEO. It's more easy when it's a team. It's really difficult when it's only one CEO.
Based on your experience, you mentioned, the numbers give you the indication whether a company obviously goes well or doesn't go well. Are there other indicators that you've experienced over the last 10 years investing into this asset class? This is going well or this is not going well?
It's always rings the bells when too many people leave the company. What I see a problem is when the CEO or the CEOs don't want the board to know the second level. Because when we know the second level, we know about the abilities of second level. And when they are too close to the CEOs might have a problem. But a CEO being too idle can be a problem, big problem. A symbol of strength to, for example, let the CFO or let the COO present to the board. Then board feels comfortable that there's a strong management group.
So you would advise searchers to also, at board meetings, involve second-level management, show kind of the perspective of the employees.
One thing I would strongly recommend is don't let CFO, CEO, or whomever participate in the whole board meeting, because sometimes you have to talk about shareholder issues or so, So let them present their part of the game. Let's, for example, have an operational part of the board meeting and a more, let's say, shareholder-related part of the board meeting. Make a short break, and then it's without the team.
In terms of the employees, what are principles or what can a first-time CEO do to rally the group behind them and make sure that employee satisfaction is tangible?
Let's say it's a very emotional thing, a very empathetic issue. You have to talk to the people and you have to make them feel comfortable with the company, with the new leadership, with yourself. So just spend a lot of time talking to them. Ask them how they feel about their role, what kind of roles they would like to have, how they would see the company, where to go the company. The answer is not increasing the salary. When there's a new boss, people always ask for higher salary. Try to avoid this. But try to make them feel well by showing them respect and interest in their feelings, in their attitude, in their whatever. That's important.
Because if you increase the salary once or for one person, everybody else will come in and ask for the same.
That's one point we have seen very often, that entrepreneurs don't increase the salaries for maybe 2-3 years or more when they want to sell the company. And they promise the people, the next owner will increase your salary. And then when you step in, you suddenly have 10% more labor cost, or whatever, and that can kill your P&L. So be very careful with this and have a close look in due diligence about the salary increases. For example, have there been salary increases annually, but for the last 3 years, not? That's a clear sign that people expect you to pay them more as soon as you own the company.
That's very interesting, and I think something now searchers should start asking for, because I think that's something you can see in the numbers, right? You don't need to speak to the people, but you can actually see the data. Is there anything else along those lines where you feel like during the DD phase with the seller, get the data early on?
Let's say the biggest problem is not the data. Again, it's people. What we see quite often is that a lot of family members of a seller are in a company. And be careful, they have different names because they've been married or whatever to somebody. So try to figure out who is family member of the seller, who is somehow related to the seller. And when you see that maybe 50% of the second and third level is related to the seller, then you might have a problem when you have a conflict with the seller after transaction. These are risks you don't see, obviously, in a due diligence. It's not a hard fact, but it's potential problems. And when I go back to what we saw over the last more than 30 years, obvious due diligence mistakes, misjudgment of an industry or reading the figures totally wrong in a company, it doesn't happen so often. Very often, it's the people, the misjudgment of the people.
What we've now uncovered is like people from start to finish is what makes or breaks a company in many, many regards. Obviously, there are other factors, and some of these other factors have been cited by Jan Simon in the ESSE study as well. High customer concentration, general market disruption, as well as government involvement in a certain sector and industry. What was the most underestimated part that searchers often get wrong, leaving the people part aside?
I think it's customer concentration. What we hear quite often from searchers is when there's a high customer concentration, they say, oh, this is a customer concentration, but these 1, 2, 3 customers are customers for 20 years now. So it's not a risk. I think that's wrong. First, if there's a change in the management of the company, maybe customers also want to change. You don't know it. But even if customers don't stop buying from the company, when it's a high customer concentration, they have the power to put pressure on your margins. They can just negotiate the prices, knowing that prior to the deal, it was just a normal company, but now it's a leveraged company. So the zero is not zero anymore. You have to make a lot of money. You have to be highly profitable, not to break the covenants from the banks. And as soon as customers realize this, they can put a lot of pressure on you. So customer concentration, for me, is something strongly underestimated.
Can you maybe elaborate first on what do you define as customer concentration?
It's really difficult. There are industries where you only have 3 or 4 potential customers. Then it's really difficult to invest in this industry. On the other hand, you can have an industry where there are hundreds or thousands of potential customers, but you are more or less supplying 2 or 3 of them only. You cannot say 25% or 30% is a problem. It's the whole circumstances. When it's one customer more than 40%, you have a problem. When you have 3 customers together having 70%, it also looks like a problem. It's not black and white. You have to look into details.
Yeah, one thing I found also interesting is, having a large number of companies from the same industry, even though nobody has or no customer has more than 5%, but in total this group makes up 50%, that's customer concentration.
Exactly.
I think that's something to just focus and double down on. Based on your experience, what have you seen in reality, in practice, in some of the companies happen?
Yeah. Now, one of the issues is exactly what you just said, Carl. It's when a whole industry has a problem, and you are focused on an industry having 2 or 3 customers in this industry. When they have a problem, you have a problem. So it's better to serve more than one industry. Yeah. That's obvious. Other thing is you can have a customer who's just being acquired by a bigger competitor, for example, and has to change all his supply management. Suddenly, this customer, people there might be very loyal to you, but now they have a new owner. They are part of a big corporation, for example, and they have to change the contracts. They have to go to new suppliers, and you lose the whole customer.
How much trust would you put into, let's say, a 1 or 2 year contract? In due diligence, searchers say, look, here, customers, there are like these contracts, which, in theory sounds very stable, but now we're talking about small businesses. What have you seen, or how would you go about it?
Imagine you buy a company, you have a 50% leverage on the share price, and you have to pay back the loan within 5 or 6 years. Doesn't help you when your customer gives you a 2-year contract. You need quite a stable EBITDA or whatever for the next 5, 6 years. And the next is you acquired a company. Most likely you will exit it again one day. When you exit in year 5 or 6 or 7, it doesn't help you when you had a strong customer for the first 3 years and then you don't have a contract with him anymore.
For today, I want to close with a question. If you could send one piece of advice in time back to all the new CEOs, what would that advice be?
Always recommend searchers only acquire a company you really like and you have fun to go there every day for the next 5, 6 years. Because it's a tough job. It's not easy and you will have problems again. So you need something that you really like, that you really have fun to improve, to grow, to whatever. That makes life more easy. And the second is, I think you always need people you can openly talk to. Being a team of searchers, having a board member or 2 board members you can intensely talk to, or just your private spouse who is the one who you are crying on the shoulder when something goes wrong.
Thomas, really, really appreciate your support and sharing your experience. We'll definitely come back with another hour of your wisdom, but really appreciate you taking the time and looking forward to seeing you in the trenches again for the next acquisition. So thank you so much for joining us today at Lineage.
Thank you for inviting me.